Hello, everyone. Today on the Final Bar, it's November 14th, Monday. We will talk about this market constructive earlier in the day with the S&P dipping just above 4,000 before ripping to the downside going into the close. What does this mean for the big picture? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. Our tools, education, and commentary are designed to help you navigate uncertain markets in uncertain times. I feel like this is yet another day, which I would describe very much that way, uncertain. The market had a certain feel going sort of the after lunch hour, right? Sort of the 1 o'clock, 2 o'clock period. S&P making a new swing high, getting above 4,000 for the first time in quite some time. All of a sudden, it felt like that recovery from last Thursday and Friday is going to continue to the upside. Nice sell-off going into the close, which is usually when a lot of institutions are involved. We'll have to look at the charts together here in a few moments and see what we can conclude about today's sell-off as we make a new low for the day. By the way, we have some really cool guests coming up for you. I'm excited for some of the conversations we're going to have through the course of this week. Tomorrow, on Tuesday the 15th, we have Larry Tentarelli from Blue Chip Daily. On Wednesday the 16th, Ryan Dietrich, the Chief Strategist at Carson Group. And then on Thursday, Julius de Kempener, founder of RRG Research, creator of the Relative Rotation Graphs, coming up on Thursday the 17th. The Pitch, our latest episode of The Pitch will be airing this Friday the 18th in the morning Eastern time. I'm going to be moderating that conversation with three great guest strategists, all giving you 5 stock or ETF ideas, and we'll debate them as a group. Go to stockcharts.com/thepitch to find more info on that regular special. Let's continue on our show today with the market recap. Let's try to make sense of things. Again, a lot of movement going into the close. It is super fun to prepare for a closing bell show when everything changes in the last half hour, but that is our lot in life, and let's get to it. The S&P 500 finishing with the distribution going into the close just below 3960. That's down about 0.9% from Friday's close, which was just below 4,000. NASDAQ Composite was down a little bit more than that, 1.1%. Mid caps and small caps, all about the same. So sort of all the equity indexes down about 1% for the day. The VIX bouncing back to the upside. Now, the VIX has been coming down over the last couple of weeks as stocks have been rallying. Volatility has been decreasing. And now the VIX has gotten closer and closer to the 20 level. That might be interesting. We'll talk about that chart here in a little bit, because that is often where the markets top out, when the VIX gets down to 20. At least that's what previous bear market rallies in 2022, that's how they've played out. The bond markets were closed on Friday for Veterans Day, back open today, and you can see that bonds sold off a bit along with equities and commodities. Not by much, though, so interest rates up a little bit, but not a ton. 10-year yields still below 4%, around 386, 387. Dollar pushing higher today, which is sort of the counterbalance to all the risk assets coming off. Within the commodity space, though, is actually kind of mixed. Gold pushed a bit higher today, silver as well, sort of slowly and steadily through the course of the day. I'm going to be speaking a little later with students at Babson College. I'm going to be doing a virtual lecture for them there in the Boston area. One of the charts we're going to spend some time with is the chart of gold, because I think it's a really interesting illustration of that rotation from a distribution phase to arguably an accumulation phase, which I think gold certainly appears to be in now. Finally, we get to cryptocurrencies. Kind of a busy weekend, right? Along with, it's interesting to have a more widely followed market like cryptocurrencies that are active over the weekend. And you could see that there's a lot of choppiness. Bitcoin got below 16,000 in the last 24 hours, chopping around quite a bit, got above 17,000, now settling kind of right at the middle, pushing lower through the course of the equity trading session. So sort of a similar risk-off feel going into the close for equities. Similar thing that we're seeing with the chart of Bitcoin. Let's continue sort of this discussion of the big picture. We'll talk about some of the broad market charts, and let's start with the chart of the S&P 500. This is what my daily chart looks like, and for my market misbehavior premium members on Saturday morning for our weekly flight plan, which is our key report, we talked about this rally in the S&P, and currently the S&P is up about 10-11% off of the lows in October, depending on where you measure it from. I usually measure it from the closes, right, on a closing basis. If you look, that's about the same amount we saw in March, right? So it's sort of a similar rally. We've actually eclipsed it just a little bit. We've gone a little bit above that rally that we had in March, which is about 11% on a closing basis from mid-March to late March. This rally here, June to August, was a little bit deeper to the upside, up about 17%. That would push us a little bit further from there. That would be up to around 4,200 or so. I'm doing the quick mental math, so I think that's about right. The good news is on charts like this, on a log scale chart, you just look at the distance. So a similar distance kind of puts it up in that area for me, which would just be above this trend line off of the highs. And how beautifully poetic would that be if that's where a rally would stall out, right at a trend line that lines up beautifully with the March high and the August high? What if this is the line that all bear market rallies end in? I don't know if that's true, and what I do know is what happened today. The S&P on Friday pushed up to 4,000, had not been above 4,000 since early September. 4,000 is an interesting number because it's a big round number, but also because it plays to a number of different Fibonacci measurements. If you take the August peak and the October peak, 61.8% of the way up is right above 4,000. Pretty much our intraday high for today is right at that Fibonacci level. Also, if you do the larger time frame from January of this year down to the low in October, 38.2% of the way up is right at 4,000 as well. So we have sort of this confluence of resistance levels basically at today's high. And you can see this blue shaded area, which encompasses that high, that level, but also the 200-day moving average, which is a little above us, around 40.80, 40.75. So the reason why I'm going through this in a little more detail is because I would say, I've been labeling this a bear market rally. I think I'd feel comfortable labeling that as long as we top out sort of in this 4,000, 4,200 range. We get above there and we sort of eclipse all of these resistance levels, which I've articulated. I think you have to start to think of this as something very different, especially because the momentum characteristics would most likely change. The RSI dipped just above 60 last week. We're back below there today. An RSI above 60 usually indicates a strong trend and often indicates further strength to be had. Now, the RSI got up to around 70, 72 back here in August. And so interesting to see if we have a similar playbook to what we had in August, which would be about another 5-6% higher. The RSI getting a little bit higher. We'll see how things tend to play out. We have a segment a little later in today's show called Shifting Stocks, where we'll look at a lot of individual names in a little more detail. But for today, I just wanted to keep it a little more high level with some of those key charts to touch on. Just very briefly to finish off this discussion about overall trends and the market environment at a high level is thinking about volatility. So there are a number of indicators that have certainly validated the fact that we're in a rally phase, particularly in the short term. And now we start to get to those points, those signals where previous bear market rallies have stalled out. And I would say some of the biggest gains that you will ever see are during bear markets. So it's not surprising that those big up moves that we saw last week happened overall. Again, I would argue still in a broader bear market phase, which I think we're still to watch through the course of this week and maybe into the holiday week after that is the chart of the VIX, right? The VIX in general tends to move inversely to the S&P 500. If you look back during the course of 2022, the VIX above 20 or at or above 20 usually coincides with market tops. A VIX above 30 usually coincides with market bottoms or getting near to a market bottom. You saw that happen in September into October. The VIX topped out around 33, 34. There about a month ago. From there, we've come back down. Previous peaks in August and in April have coincided with the VIX below 20 or right at that 20 level. We're getting very close to that. If we see further upside, that's where I would be looking to see, some sign of a potential exhaustion in the uptrend. Continuing on our show, we have sector setups. We talked about the big picture here, the rally in the S&P, again, approaching some key resistance levels, volatility declining to a similar level that we've seen at the end of bear market rally phases. So I think an open question as we go through the course of this week, a lot of earnings, which we'll talk about through the course of the week as well. Let's now rotate to sector setups, talking about the 11 S&P sectors, what sort of lessons we can derive. Today, just to start the conversation there, most of the 11 S&P sectors down, along with the markets themselves. A lot of this really accelerated in the last hour of trading. By the end of the day, the real estate sector, actually the worst performer, down over 2.5% today. Consumer discretionary, the XLY was second from the bottom, down 1.5%. Financials down 1.5% as well, followed by utilities. So sort of a mix of offense, cyclicals, defense, sort of a mix of things all at the bottom of the return list. What actually outperformed today? A handful of sectors were sort of flat to down. Healthcare just narrowly in the green. We're still processing the closing ticks. You can see things bouncing around a little bit, but you can see the XLV, up about 0.2% as of the time we're recording this. Energy down just a touch. Materials down 0.1% as well. So three sectors sort of flat for the day. The average sector down and pushing the S&P a little bit further to the downside. Let's now go to the RRG. I'm excited to have Julius DeKempener on the show later this week. He'll be in on Thursday. We'll have a conversation. We'll look at some of these RRG charts together and talk about some key themes. When you look at the weekly RRG data, so this is looking at weekly data, so it's the last 6 observations or 5 observations I'm showing here. So basically the last month of readings, but it's using a longer data series using the weekly time frame. So it really captures sort of that medium-term rotation, or what I would describe as that medium-term rotation, the cyclical relationship on a relative basis of these sectors and how they rotate around the S&P, which is at the crosshairs in the middle of the diagram. You can see that the energy sector has been certainly the outlier for quite some time. And if you rewind a little bit, you can see how energy has just spiked to the upside. It's cooled off a little bit, so you can see it's heading kind of, we'll call it east-southeast as opposed to due east, but overall still in a position of strength and by far the strongest of the 11 S&P sectors. But after that, you have this cluster of sectors doing pretty well. And if you look at what's happened over the last 6 weeks or so, financials, healthcare, industrials, all improving. And when I was scanning for stocks making new swing highs last week, writing a note for my premium members, I noticed a lot, particularly in the financial sector and in industrials. Actually, a surprising number in the industrial sector, more than we've seen previously. Healthcare we've talked about actually, because there have been some interesting spikes in pharmaceutical names, some biotech names certainly showing some nice bounces. Look at what's not working and look at what's weakening on this weekly time frame. Consumer discretionary, probably the most notable, now in the weakening quadrant for the first time in many moons. The utility sector has now left the weakening quadrant, now in the lagging quadrant as well. Technology, communication services, real estate, all down in that area as well. One of the areas of improvement, it's sort of this improving quadrant, has often been sort of your, or how I would think of it, sort of your group of potential investors, right? Your investment candidates, and you look to see what is improving, what's still underperforming, but the momentum is starting to shift. The only one in that quadrant as of today is the materials sector. When I'm looking at the charts of the GLD, the XAU, some of the gold stocks, some of the mining names, these are names that have certainly been struggling for much of 2022, starting to struggle a little bit less and actually starting to break out a little bit in some cases. So maybe an area, if you've not been thinking about the materials sector for a while, might be important to focus on. It's so interesting looking at this relative rotation graph, by the way. If you go back to 1980, and I am making up some of these numbers, so apologize for that, but I don't have them in front of me. At some point, I will actually review them and have the correct answer for you. But if I remember right, back in 1980, the biggest sector in the S&P was the energy sector. I don't remember how large it was, but I would say probably 20-25%, if not a little bit more. Think about now when energy is dwarfed by things like consumer discretionary, technology. Back then, energy was the biggest sector. Back in 1960, if I remember right, I think it was materials was the number one sector because you had steel companies and others that were just huge. And it was a very industrial economy versus a service-oriented economy, which is what we have now. So think about if our benchmarks were a little different and if our benchmarks were dominated like energy, like it was in 1980, were dominated like by materials like it was in 1960, what would the S&P actually look like? And I would argue, certainly with the weakness that we've seen in 2022 from those growth areas of the market, our benchmarks actually could look a lot better. It's a great reminder to think about the construction of some of these major indexes. The S&P is not this perfect encapsulation of the markets. It is an imperfect measurement of the overall trend by trying to aggregate some of the different parts of the market, but is very growth oriented right now. So when value works, the benchmarks struggle, even though some of the individual names you might look at are actually relatively strong. Just to finish off our conversation about sector setups, let's look at the 11 S&P sectors using our candle glance function. This is a great way. This is one of my favorite tools on StockCharts to take a group of stocks or ETFs or indexes, throw them on the screen all at once, and just start to compare them, right? Where do you see similarities? Where do you see differences? Which of these charts are in a positive configuration, meaning they are making higher highs and they are above two upward sloping moving averages? Not many is the short answer. The one obvious outlier has been the energy sector, right? And for quite some time has been in an uptrend, while most of the 11 S&P sectors have been in a downtrend. But now you have a group of sectors that are actually recovered they've recovered above their 200-day moving average. Their moving averages are either flat or starting to slope higher a little bit. Those might be some interesting areas, particularly if you are buying into the further recovery thesis and you think equities are just going to continue to strengthen from here. These are the places I would probably look for opportunities. What fits that description of being above the 200-day moving average? Moving average is starting to slope higher. Healthcare, the XLV. Industrials, the XLI. Financials, the XLF. Materials, the XLB. Remember back on the RRG, those were the sectors that were sort of in that leading quadrant, showing renewed strength. Or in the case of materials in the improving quadrant, but actually showing signs of relative improvement. Focus on those areas, focus on those sectors and those themes that are showing some strength. The last chart I'll show you here before we take a break is the XLF, stalling out at the August highs potentially. We were breaking out Thursday and Friday, today back below. Now I think you're looking for follow through. Does the XLF make it above there? I wouldn't be surprised if this is a bear market rally. This is where charts like the XLF could potentially top out. We'll take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so great to be back live with all of you, sharing some insights and some observations about the markets and how they're evolving every trading day. A couple quick announcements before we get to my next segment. First off, we will do a mailbag segment twice this week, on Tuesday's show and again on Friday's show. We would love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. Give us a follow there. And also subscribe to our YouTube channel called Stock Charts. We will always entertain questions in the comments section of all of our videos. We'll review those as well and hope to get your question live on the air on Tuesday's show. Also, go to StockChartsTV.com. That's our on-demand platform. Larry Williams is recording a new market outlook, which we'll be posting this week if it's not out already. We also have a special coming up from the guys at Go No Go Charts, Alex Cole and Tyler Wood, and a lot of great content from our great suite of guests and Stock Charts TV hosts. Go to StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on our show today, with our third sort of prong to this fork that we use on Monday. We start with the big picture with the macro environment. We then talk about sectors, and then we finish off talking about individual stocks. Monday's show sort of is a summary of my regular weekly routine, going through the macro down to the micro from a technical perspective. I like to hit on some of the key charts that I'm observing during that routine. And we'll start with semiconductors, right? One of the interesting themes about 2022, as the markets broadly speaking have been very risk off, has been the weakness in semiconductors, right? Semiconductors overall have been in a downtrend, just like the S&P. But not just that, semiconductors have been underperforming. And this is one of those groups I tend to think of as a bellwether group. When semiconductors are doing well, the overall economic conditions are probably okay, particularly in the growth space, because semiconductors are literally the backbone of our modern service-oriented economy. Certainly the modern technology that we're using is driven by semiconductors. So if they're doing well, things probably appear to be pretty good from an economic perspective. It reminds me of Charles Dow and how he was thinking about the producers of goods and the distributors of goods. Semiconductors are kind of, a key component to the economy. Are these companies doing well or not? They have not been doing well in 2022, really peaked out in November of last year, retested that in January. And from there, we've gone lower, but we've had a nice rally. The SMH, which is one of the pretty liquid semiconductor ETFs, back above the 50-day moving average. That happened about a week ago. From there, it's continued higher. And just on Friday, narrowly touched the overbought region with the RSI. It's not lost on me that that is pretty much where we stalled out this bear market rally in early August. The SMH became overbought, and right about then, we had sort of the reversion to the downside. So I'm watching this chart among many to see how the remainder of this week plays out. The rally that we've seen is very similar to the rally we had in July and August. It's actually a little bit further than we got in that range, and well beyond what we saw in March. So right at that decision point, I think, where you have to consider whether or not this move has longevity. If we would continue higher, some clear resistance, sort of that 245 to 250 range. That was the peak in early June. That was the peak in August after that rally. So retesting that level would make good sense from a technical perspective. Obviously, breaking above that, and all of a sudden, this chart looks incredibly constructive. Making a higher low would be another good one to note as well. So if you sell off, keep an eye on 180 there. Right? That was the low from early November, from about a week or so ago. Now, within the semiconductor space, you have a lot of individual names with quite a bit of divergence. Now, the chart of NVDA looks very similar to the SMH. You can see a lot of similarities here. Just hitting the overbought region today, actually, after sort of maintaining the high from Friday. These stocks all gapped on Thursday and followed through to the upside on Friday. A very clear resistance level right around 190, 195 on the chart of NVIDIA, and the 200-day moving average is not too far above, around 183. So while I am super encouraged by this rally in stocks, I did a webcast a couple of weeks ago. We talked about a bear market, or a market bottom checklist. As of 2 weeks ago, 2 Fridays ago, 7 out of the 10 items on my market bottom checklist were checked, meaning it has fulfilled the conditions for a market bottom. So I'm not surprised to see this continued strength that we have. The question is, how do you differentiate it from a short-term rally versus a medium-term or long-term rally, right? And so I've always measured that by follow through, right? Do we hit resistance levels and then break through? A lot of the previous rallies that we've seen in 2022 have failed to break much above previous resistance levels. That happened with NVIDIA stalling above the February high there in March. Here in August, being unable to get above the June high. So I think as we rally a little bit further, resistance clearly expected there. So I'm impressed by the rally. I'm not impressed, or I'm a bit, skeptical given the confluence of resistance on the S&P's chart, on charts like NVIDIA, right? Just above where we're at, some pretty key resistance levels as we become overbought. So that's an important sort of pattern and phenomenon to watch with a lot of names, particularly growth names that have rallied so well off of the bottom. Now compare that. NVIDIA is really just about 4 weeks, we'll call it, into a new bull market phase, particularly on the short-term time frame, obviously with a nice rally off of the October low. Very different look on the chart of Netflix. I wanted to highlight that today. The S&P down about 1%, Netflix up 3%. And this is not unusual, right? Netflix has been an outlier really since May. Most stocks, and a lot of the growth stocks, continue to go down through August, September, October, with a bounce in the middle there, of course, but overall still making new lows in the last 6 to 8 weeks. Netflix, very different, right? Actually bottomed in May, retested that low in June, retested it again, essentially in early July before rallying. Then you have this consistent pattern. We have a resistance level, we break it, sort of settle into a consolidation range, August, September, October. We now gap above the breakout level, pull back, and then rotating back to the upside. That is the type of chart, to be honest, I would be happy owning in any environment, right? Despite what you think of the broad market, I have always thought that it's always a good time to own good charts. Charts like this, making higher highs and higher lows, which I would argue Netflix certainly is, very much an encouraging chart. It's worth noting this is now in the top 2% of large cap stocks, according to our StockCharts scooter rankings, which is based on a trend following momentum model on 3 different timeframes combined into 1 percentile ranking score. It's on the top 10 list earlier today when I was looking at charts. A couple other names just to finish out our segment on shifting stocks. 2 big box retailers reporting earnings tomorrow. We have Walmart and Home Depot. Then again on Wednesday, we have Target and Lowe's before the open. So quite a bit of the big box retailers, some of the consumer names as well to pay attention to. When I'm looking at Walmart, I'm struck by the fact that you have the August peak here. around 142. We've now retested that peak. We got up to around 144 about a week ago. Today's selling off, and it sold off a little more than the broader market today. The S&P again down about 1%. Walmart down about 3%. It's always interesting to note what is underperforming or outperforming on a particular day, but then think about that in relationship to the overall trend. When I look at the chart of Walmart, I see a high in August. I see the stock retesting the high, but from there, unable to follow through. And what happens with earnings coming up tomorrow morning is you have a catalyst or a potential catalyst. The stock most likely moves before the open. Tomorrow's session most likely a little heavier volume and heavier uncertainty as we react to earnings. So far, selling off going into the report today. The other one's Home Depot, kind of a similar feel to this where you've rallied. It's not as clear-cut as Walmart. We had a clear resistance level. Here it's around 330. You can see we broke above the 200-day moving average. We've not quite made it up to that 330 level, but now we pull back a little bit today. So two of these names going into earnings tomorrow, selling off a bit today. Important charts to watch because if names like this can get above their August highs, both Walmart and Home Depot, talk about a vote of confidence for the broader market resuming an uptrend or continuing this rally phase into something a little more meaningful. We need to wrap the show, folks. Boy, 30 minutes goes by so quickly, but it's a pleasure to spend some time with you. We need to go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Just coming back a week back from India, fantastic trip to Mumbai, and met so many wonderful people, including a number of StockCharts users and StockCharts TV viewers, which is an absolute pleasure. So shout out to all my friends in India watching the show, most likely tomorrow morning, but I appreciate you joining in on demand. Wanted to start because the whole journey to Asia made me think about different Asian markets, looking at different Asian benchmarks and thinking about how they relate to what we're seeing in the U.S. I mean, if you look at South Korea and you can do $ Kospi, which is the main South Korean index, or EWY is the South Korea ETF from iShares, maps pretty well what you see with the Kospi, but with a bit of a dollar adjustment in there as most of these ETFs have. This is running my market trend model. So this is looking at long-term, medium-term, short-term, and then just a little thumbnail expanding the most recent data. You can see in the short term, this has been bullish for the last 4 weeks. The medium term turned bullish a week ago, and you can see that the long-term model is still negative. That is exactly how this chart looks to me. So it's interesting that South Korea, which is a very semiconductor technology-oriented benchmark, having a nice rally to the upside, pushing higher. I'd love to see if it could get above 62.50 on the EWY. That would take us above the August highs. And again, you're noticing on a lot of these charts, we've rallied beautifully, but we are now rallying up to some key resistance levels. These charts get above their August highs. All of a sudden, this market looks way less like a bear market rally and way more like something bigger and more meaningful building to the upside. Chart number 2 is Netflix. We talked about this in our segment on shifting stocks. Great example chart of how individual names can diverge very much from the benchmarks, right? If you looked at this chart of Netflix, would you guess that the S&P and the NASDAQ made new lows in October? I'd probably guess, probably not, because Netflix is a pretty big name and it most likely reflects what we're seeing elsewhere. But Netflix had a big deterioration in the first half of the year, way more. It underperformed in the first half of the year, and now really outperforming in the last 6 months. You can see the relative strength obviously deteriorating quite a bit into the May low, but from there slowly and steadily improving. Higher highs and higher lows, by definition of Charles Dow, is in an uptrend. Finally, we have the chart of the VIX. As I mentioned, when you have a bear market rally, as again, I feel very comfortable labeling this as such for now until we get some of those follow-through charts that I mentioned before. But as you see the S&P moving higher, you have to start looking at other conditions that can help you validate whether we're having an exhaustion point in that rally phase. We talked about the bullish percent index on Friday and how we're above 70% on the S&P's bullish percent. Look to see if we rotate back below 70%. Did not happen today, by the way. You can also look at the VIX, right? And you can see this this relative movement of the VIX getting down to 20, and that has coincided with the major peaks going back to November of last year. If we see further upside in the S&P above 4,000, if you see the VIX get down to 20, I would very much be concerned about upside exhaustion. Folks, that is a wrap for this show. Thank you so much for joining us every weekday after the close for the final bar. We have some great guests coming up this week. All of our previous interviews and episodes are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.